All right. So, good evening, good afternoon, good morning, everyone, depending on where you are around the world. Welcome to our global webinar on the topic of hybrid innovation. My name is Gvirtsman. I'm the Chief Knowledge Officer and co-founder at Spyre, Innovation Ecosystem Design. And I'd like to welcome you to today's webinar. I'd like to start with a short story, and then I will hand it over to our great speakers that have joined us today. So I don't know how many of you are familiar. There's a board game that's called Stratego, and I've been blessed with 3 children, so we like to play this game around the house. And this is a true story. Some time ago, one day I came back at the end of a long day at the office, and my middle son was waiting for me with a box. It was open and ready, and he was looking at me and he said, "Daddy, today I want the bombs to move." So at Stratego, those of you who are not familiar, there's a piece that's called a bomb or a mine, and it's not supposed to move. And my immediate reaction, this is a completely true story, he will corroborate if you ask him. I told him, come on, you have like an hour before your bedtime and you haven't taken a shower, you haven't had dinner yet, and the game takes too long. And besides, the instructions clearly state that bombs are not supposed to move, so let's just play the game. But then I caught myself because I was 6 months into running a global innovation ecosystem inside HP software. And I told myself, you are running a global innovation ecosystem. You are flying around the world, telling employees at various sites to be innovative, to think out of the box, to be creative, and to dare. And your son comes to you with this beautiful idea, and that's the answer that you give him. So shame on you, Achi. So I took a deep breath and I told him, you know what? Let's try. And we tried it, and it was so great that today, true story, our house rules are that bombs can move at Stratego. That's how I played with his younger brother today. But he also wanted the flag to move. So you're supposed to capture the opponent's flag. So if the flag can move, the game never ends. So we tried that as well, but we let that one go because it didn't work so well. And the reason I'm telling you this is that if you had asked me at the time, I would have told you that I constantly encourage creativity with my children. But in the same way, executives, if you talk to executives around the world, they will, and that's what I do as part of my work at Spyre, they will tell you that innovation is really, really important to them, that they're investing in innovation. They want their employees to be creative. They want the employees to be more daring. But at the bottom line, there is a moment in time where executives are facing 2 options. They have an innovative opportunity in front of them, and they have a project that is waiting in the backlog that customers have been clamoring for, or this technology that they need to support, and they have limited resources. Where are they going to invest their resources? In something that has a high risk of failure, and even if it is successful, they're not sure what the ROI is going to be, or something that is much safer, that is taking care of things that are in the here and now, but are not looking forward to the business and what it's going to be like in 5 years and in 4 years. Um, and the reason that corporate innovation is such a fascinating topic is that it really revolves around that moment. That's like the critical moment where decisions are being made. What are we going to put in our backlog? What are we going to invest resources and funding in? And the reason we're calling this hybrid innovation is twofold. First is because we are looking at innovation ecosystems inside established organizations as both a vessel to bring forward organic innovation and also innovation that is based on external technology that comes from startups, from established corporations, from academia, and so on. And another thing is that we think that there's a lot to be learned from the world of venture capital, from the world of investing, when we are looking to create an innovation ecosystem inside established organizations. That's kind of the backstory of why we are promoting this topic of hybrid innovation and the reason why we set up this global webinar today. So without further ado, I would like to introduce our first speaker. So our first speaker is the co-founder and head of business development at iLab Collective. His name is Bobby Amiri. Bobby, thank you for joining us this evening. I will let you introduce yourself, and looking forward to hear what you have to share with us today.
Absolutely. All right. Thanks, Ahi. And let's see. I'm going to share my screen now and then introduce myself. So bear with me. But I'm really pleased to be here with you all today. I'm going to be talking about the topic, what VC risk mitigation teaches us about practicing corporate innovation. And as Ahi mentioned, I'm with a company called iLab Collective, and I'll talk a little bit more about our services. But in summary, we offer corporate startup acceleration programs as well as a venture studio, and we do some startup scouting as well. Although that's not our sweet spot, we're really excited about the future of the venture studio model. So I'll go into that a little bit later. But just to kind of kick things off a little bit about my background, I am a native of Silicon Valley. Lived here practically my whole life, although I have lived in Tel Aviv for a few months, a fantastic place, as well as Sao Paulo, Brazil for a couple of years, and Costa Rica. So very globally minded throughout my career, previously working for HP and IBM in sales and marketing role, but most recently, the past 6 years or so, working in the startup ecosystem. Initially with a company called GSV Labs, which stands for Global Silicon Valley, is one of the larger incubator locations in Silicon Valley. And I started a program called the Pioneer Accelerator in conjunction with Google Developers Launchpad, where we took a look at and accelerated very early stage startups. So these were all pre-seed companies for the most part. Certainly helped them raise quite a bit of funding throughout my time working with early stage startups. Also am an investor at Bolero Ventures, a VC out of Guadalajara, Mexico. And I also focus quite a bit of my time and energy on social impact. So I'm a business lecturer and director of accelerator at Street Code Academy, which is a nonprofit coding school in and around the East Palo Alto area of the Bay Area. And as I mentioned, very excited to be here today and speak with you on the topic of mitigating VC risk and how that applies to corporate innovation. All right. So we all know this, right? New ventures naturally have a high failure rate, upwards of 90% in some cases. And that's just consistent with what we see across any industry when new ventures are introduced into the market. And for every well-known tech company that we see, including Google and Facebook and a host of others that we're all familiar with, there are hundreds of venture-backed startups that went out of business. And that's not for a lack of having a great idea. They could have had a fantastic idea, but there are so many factors that go into the success of any new venture. It could include execution of that idea, hiring the right people. It could be timing. It could be accessibility to the right partners and network. But it's not for a lack of idea. That's what I want to drive home here. Therefore, venture capital firms expect a high mortality rate in their portfolio of companies. It's almost baked into the model. And that's not necessarily a bad thing. It's just something that we've come to expect in the VC community. And it's just a nature of the business as we call it. And so for all these big companies that actually have that actually do make it, there are, as I mentioned, hundreds of startups that don't, and that's just part of the expectation there. So how do VC firms mitigate the risk involved? The first thing that comes to mind is diversification, and that can come in a few different ways. Time diversification. So most VC funds are committed probably closer to the 5 to 7 year period. Kind of depends on the fund and stage of the startups that VCs are targeting. But that's certainly a consideration because across time, you can expect there to be ebbs and flows, new technologies that are introduced, and as a result, the market adjusting to those new technologies. And so in order to mitigate the risk of the new entrants in the markets, time is certainly a factor and one that we like to spread across in order to mitigate that risk. Another factor is stage. So some VC funds diversify based on early stage companies against later stage companies, which typically have less risk and nearer returns, but also fewer returns. There's a VC that comes to mind, Riverwood Capital, that focuses on Series B stage companies and later. And they typically only make 4 to 5 investments per year. But of those 4 to 5 investments, there could be acceptable returns based on the risk involved. And then by sector. And so there's generally some funds we find that have a mix of companies. They typically may focus on anywhere from 4 to 5 verticals, whether it be healthcare or agritech or fintech, and so and life sciences, which is probably historically speaking a much more safer a venture, because there's a lot more research and planning that goes in that's involved in propping up a company like that, as opposed to SaaS companies, which carry inherent risk because it's such a dynamic industry and technology. And then by geography, so some VCs also, look at emerging markets in Southeast Asia and Latin America, and Western Europe or other parts of the world as well, to kind of get a mix of different companies that they might be interested in diversifying their risk in that way. Now, while I was at GSV Labs, there's a framework that we typically use in taking a look at some of these early stage companies, and the 3 Ps could be the 4 Ps, but basically it's product, potential, and people. Plug and Play Tech Center down in Sunnyvale, they have a similar type of framework. They call it the 3 Ts, which is traction, team, and TAM, total addressable market. So as we look at the 3 Ps, though, the product obviously looking for disruptive technology, not necessarily iterative, something that can truly change the way that we even think about business. But probably most important, I would say, is the people. So ideas kind of come and go. There's countless examples of companies that have pivoted, but some of the important qualities that we look for are curious founders, always studying, always looking for new opportunities, very rigorous in their personality, and obviously having flexibility, understanding their vision very, very clearly, and having an economies of scale mindset. So not necessarily just looking at a 5x return, but something far greater, because if we can figure out how to scale this and take it global, there's certainly a higher return for the investors who are interested in really producing high returns on their investment. And then having a networking mindset and thriving in uncertain conditions are also very, very key qualities that we look for. And personally, I think our team, we look for mission-driven founders as a plus, all things considered. And then potential. So startups, as I mentioned, having that high growth mindset with a potentially global total addressable market that are solving key issues, not just in your local kind of area or territory, but all across the world if possible. But most of all, VC funds need to invest in a high number of startups in order to mitigate their risk. I always bring up the baseball analogy. Batting percentage versus slugging percentage. So if you're looking at batting percentage, that could be someone bunting every time and getting the first base, but that doesn't necessarily mean that runs are produced. In other words, scores. And so if you look at slugging percentage, people that are able to get doubles and triples and home runs, those are typically, it's a good indicator, a metric of success and ability to produce for a team in the right way. And we look at typically VC capital and the way that we approach looking at startups and evaluating them much in the same way. Is this going to be a home run that allows us to pay for our entire portfolio? Because, as I mentioned, it is a very risky space to be in. So how does this apply to corporate innovation, which is why we're all here today? Well, raise your hand if you've seen this before. The challenges of innovating within a corporation include the pace of decision making being extremely slow. I can tell you, having worked for HP and IBM firsthand, innovation can come at a snail's pace in certain cases, because by nature it is a very large and bureaucratic organization. It's almost like shifting a large aircraft carrier in a completely different direction, and it takes time it takes having everybody on board, and that doesn't always come easy. Institutional bias can be difficult to avoid. When you're working for a company for so long, it can be difficult to think different. Brand risk can be a challenge when innovating internally. No one wants to rock the boat, do something different, because you've been injected into this, this brand and this culture that you become accustomed to. And so no one necessarily wants to rock the boat and do something different, because it can be looked at as being extremely risky for their careers. And then it's hard to get a clear signal from existing customers. If you're working with them in a certain way, and they're used to working with you in a certain way, it can be difficult to really get them to think differently with you about how to solve a particular issue in corporate innovation. But we find that diversity of ideas is key to successful corporate innovation. Some of the most disruptive and groundbreaking innovation has combined experience from inside the organization with an agile startup inspired approach from external teams of experts. And I love this quote out of the Harvard Business Review that touches on that subject. And so in order to really make a change and look at different ways of thinking and addressing problems and business models and products, we want to make sure that we think very, very differently and address that through a diversity of ideas, because the worst thing you can get caught up in is groupthink. And I think we've all seen that before in business, and it can be paralyzing. So what are some of the various mechanisms for open innovation? And we've ranked things on impact. I'm open to discussion on this. This is not gospel, but certainly some of the things that we've seen include hackathons for sourcing new ideas, which is a collaborative product design sprint over the course of a weekend in most cases. We've looked at pitch competitions, where there's prize money offered for bringing in, companies to then pitch to a group of executives at any given company that's sponsoring that particular pitch competition. We've looked at scouting and pilots, which are sourcing global startups with existing technology that fit the needs of a corporation, which can be extremely impactful in certain situations and when done right. And we've seen that model here in Silicon Valley and beyond work quite well. And we've also looked at accelerators and pilots. These are programs, corporate run accelerators that are in conjunction with external agencies that allow for collaboration by identifying and learning from new and potentially disruptive technology that can help a company. One of the companies that we work with is Visa, which is looking at new disruptive fintech companies that they can both learn from, but then also run some pilots with. So certainly, corporate run acceleration programs is a mechanism that we've seen have tremendous success, not only in identifying new products, but also helping executives from within large, traditionally bureaucratic organizations to think differently about how to think like a startup and think more in the mind of a lean startup, and producing some of these disruptive ideas and ways of spreading that thinking to the rest of their teams. And then finally is the venture studio model. And I don't have a whole lot of time left, so I won't spend too much time here on venture studios, but this is basically a company that builds startups for a corporation. And so the benefit there is that you can do this at a fraction of the cost that it would take to hire developers, to train them, to start to go through ideation within the corporation and produce some significant results. There can be time loss, there can be money loss, but the venture studio model is interesting because it allows corporations to work with companies like iLab Collective and Mach 49 and High Alpha and a host of others to help them find product market fit with new innovation, and then focus on growth to a point where they can leverage that technology and innovation internally or spin it out into its own company. So in summary, whether you're looking at something internal or collaborating externally, there's a portfolio approach that needs to be considered. Go back to what I said initially about diversification, and how in the VC community, there's portfolios typically have a high fail rate regardless. So some of the best ways to mitigate that include diversification and having a high number of activities that can help you produce that home run that you're looking for. And then ask important questions. So no 2 years are alike. If we look at 2019 versus 2020, they don't look anything alike. I'm certain we can all agree on that. And so what's in store for 2021? Is disruptive growth near your core business or further out? Are quantum computing and AI accelerating or decelerating? How are millennial buying habits affected by COVID changes in the way that we approach business due to the current state of the world? So these are all important questions to consider when thinking about corporate innovation. And then what's called pattern mapping. So if we look at, as I mentioned, 2019, 20, 21, you can start to visualize, at least from a bird's eye view, what are some of the things that we thought were big bets in previous years that didn't quite make it, based on just new disruptive technology, based on market factors. So the question is then, where do we look at where disruption is currently happening and why is it happening based on that pattern mapping, which can be very powerful. And then for some companies, I would just ask you to consider that these innovation efforts that we're talking about may be less than your coffee budget. So consider the learnings that you can get from diversification in some of these activities that can produce really high bets that that can transform your company and keep it competitive for the future. And then finally, and I'll leave with this, there's not a cookie cutter model. As I mentioned, diversify your approach and find a way to leverage external innovation, because that can truly be the difference between a company that has staying power years down the line. So I'll leave it there. And certainly if we have some time for questions, I'm happy to answer any questions. But thank you for your time. And I hope that you enjoy the rest of the talks today.
Thanks, Bobby. Fascinating stuff. So guys, if you have questions, feel free to write them in the chat. Merav, can they unmute their lines and ask a question if they want?
Yes, I'll give everyone talk.
So folks, any questions for Bobby? So while we wait for the questions, Bobby, I actually have a question / comment. So you were talking about how the high mortality rate the VC firms are expecting. You're saying that it's baked into the formula of a VC, that they're expecting that the vast majority of what they're investing in will actually not materialize. And I'm thinking to myself, how many corporations will be willing to invest in something that so much of that investment is not going to be to return. I think, and I'm going to actually touch on it in my session, but I think this is really one of the barriers. It's like the mindset of you want ROI. Corporations are built around expecting ROI. So I see some questions here. So what is the difference between accelerator and scouting activity?
Yeah, good question. So, excuse me, with the scouting program, essentially that's when you work with a team, or you have a team internally that looks for new startup technology that they can potentially introduce you to and run pilots. I would say there's more of a transactional nature for startup piloting, startup scouting, as opposed to an accelerator, which typically allows you to build a relationship with a startup over the course of 4 months or so, which is typically the length of some of these programs. So it allows you to really learn from the startups, to really work side by side with the founders of the startup and run some of these pilots a little bit more holistically with the corporation. So it's a little bit more hands-on than startup scouting.
So I see a question from Dov. I'm not sure I understand it fully. So please relate to the individual entrepreneur. What should be his point of view or her point of view when deciding based on the 90 to 10% statistics who to work for? So I'm guessing, so Dov, please elaborate, but I'm guessing you're asking what would be the best format to kind of attach yourself to as an entrepreneur?
Yes, sorry. Yes, well, the point of view of the entrepreneur within the corporate. This is the main issue that I'm trying to raise here. An entrepreneur has the option, to go on his own way, and then to go through all the hurdles that any startup is facing. And on the other hand, he can join a corporate where he can find himself and where he can bring himself with his good ambition and contribute to the growth of this corporate. And dealing with this kind of entrepreneurship inside the corporate is something of very great interest. And please, if you can relate to this, how do you
Yeah,
nurture entrepreneurship inside the corporate?
yeah, that's a fantastic question, and we see quite a few of the companies that were born out of startup culture who are thinking every day about that very thing. And so when we look at companies like Google, for example, that have their 80/20 rule for uh, employees that work for Google, they can spend 80% of their time on their specific workflow that they've been hired for, and spend an additional 20% of their time on new ways of thinking about processes, products that could be game changing for Google. And so they actually love hiring people who have previously, started companies that have had failures and have learned from them. And so, having that critical, thinking mindset within a company can be very, very powerful. And so, hiring entrepreneurs is actually part of the Google hiring process, and something that they look at very, very, very diligently. So as you think about your company and the way that you hire employees, I would encourage you to maybe, and this is not a one size fits all solution, but certainly if you're able to create a culture around thinking differently, around innovating and doing and aligning some of the processes that manage an employee's time to do so, and execute against some of those new ideas, it can be very powerful. And certainly you retain the intellectual property within the organization. You empower the employees to do bigger and better things than what they were hired for, and it can be a win-win in both situations.
Thank you.
And I see a question from Joachim. Where to start with open innovation, accelerator or scouting?
Yeah, I would say where to start is planning. You want to spend a good deal of time understanding where you are as an organization, where you want to be, and some of the ways that you can get there. And there's not, I wouldn't necessarily say to start with accelerators or scouting or a venture studio. It really depends on what level of impact you want, what your capabilities are as an organization, what your culture is like, et cetera. I'd say kind of and perhaps Neal can speak to this, it's particularly on the scouting front, that can be very powerful if you don't have the capabilities within your company to really stand up something like that yourself, and working with other organizations to help you source new technology can be really, really really important for you, as you look at your innovation activities. So it really just depends. I would say to stand up an accelerator, it does take more of a commitment through from your leadership. Having the right people in place to manage it on the corporate side with the company that you're working with and the companies that are part of your accelerator. So it's a little bit more involved. So it really just depends on what your capabilities are as a company.
Cool. Thank you, Bobby. Any other questions? All right.
This is great. Thanks, everyone.
Thanks, Bobby.
All right.
All right. So to our next speaker today. So we have with us Neal Hansch. managing partner at Silicon Foundry. So I will hand it over to you, Neal.
Great. Thank you, Ahi, and Bobby as well. All right, I'll share my screen here. And probably not surprisingly, you'll hear some similar themes that Bobby mentioned and Ahi opened with, and probably some, augmenting some of the answers to the questions as well that just came up. So, and what I'm going to be focused on is usually like to focus on success, but in this case, it's the other side of the coin, which is where do corporations commonly fail when interacting with startups. So real quickly on my background, mostly because it kind of helps explain where we sit in the ecosystem. So normal times, that would be our office that I'd be sitting in, not my living room here on the right in San Francisco. My background also, like Bobby, decades and decades in Silicon Valley, and having worked at big corporates, having worked at startups, and having worked also as a venture capital investor, which is kind of the ecosystem, the intersection of which for Foundry's business we operate. Very quickly, so Silicon Foundry, we're essentially a boutique advisory firm. We say the word membership, that's our term for clients or customers, but we work with leading global corporations effectively, and as Bobby was referencing, acting as their eyes, ears, guides, scouts, navigators, helping them identify which emerging companies, and by extension, new technologies, platforms, services, business model innovations that they should have on their radar screen, and most importantly, be engaging in one way, shape, or form, either because they want to be a customer of these startups, or a partner, or a strategic investor, or in some cases, acquirers. So just one or two more slides on Foundry. So this is where we fit in the ecosystem. We work for the corporates. We work for folks like yourselves. Although we'd say our real asset is our relationships with the founders, CEOs of startups, the VCs that back them, and then the other nodes of the ecosystem, which I think, the three of us speakers here today count as nodes across the ecosystem. And then on the right, again, for all of our work with these corporates, ultimately the end game is to see outcomes at the end of the year where they're working with 4 startups, right? They're using their solutions in their shopping malls and their bank branches and their telco networks or what have you, or they're doing strategic partnerships, which is a deeper relationship. Or many of you may be aware, but corporates more so than ever before are investing directly into the startups, often because they have a commercial relationship and it's a way to have deeper ties, influence often on product roadmap. And in some cases, if corporate's working with a startup, they're kingmakers, right? They're going to be a huge customer of theirs, and so to capture some of that upside. This is, and back to what Bobby was saying, this kind of touched upon it as well. So for our work, most of these corporates, they have one or multiple activities already going on, right? They may have an accelerator program, or they got a labs group, or they have a really active corporate development, business development team, the team that's doing strategic investments and or acquisition or driving partnerships. And so, the idea for what we do is to plug into those activities, because it's not an either or, right? It's a portfolio approach. Ultimately, it's the question of what are you trying to accomplish? What's the right vehicle to go about accomplishing that? And what's the definition of success as you're engaging with startups? All right, so who's engaging in partnerships, AKA who's actually working with startups? On the left-hand side, it is everybody. So maybe 20 years ago, you'd see a certain kind of swath of corporates who are really active in the startup world. And now, and you probably see this most directly in the launch of corporate venture capital arms, it's every single industry coming from everywhere in the world. I think the most fun one I saw was Sesame Street launching a corporate venture capital arm. So if they're doing it, and Campbell Soup doing it, there is no corporate left untouched in terms of, right? It's the senior leadership recognizing we need to tap external innovation. And I think that's a key theme, right? This is about, at least for our work for Foundry, it's how to tap external innovation. And that's not to say there's obviously tons of internal innovation happening. I think to the question earlier, entrepreneurship versus external entrepreneurship, and they're very much interchangeable. And we laud as much as anything the entrepreneurs, because entrepreneurship is very difficult, and say entrepreneurship is just as difficult, just a different series of challenges and hurdles, but massive platforms and assets and resources to work with. So on the right-hand side, I think we've already covered that, but I think it's important because you're going to get back to, all right, if we want to work with startups, interface with them, what's the right channel? What's the right mode? I think what we see most directly is or most often is, hey, we have a series of challenges. We have a series of problems. We have a series of issues that often the business unit heads have come to some sort of centralized innovation team. And in our work, we work with CEOs, chief digital officers, chief innovation officers, chief strategy officers, heads of corporate development, business development. Really, the answer is whoever's job it is to figure out what the hell is happening externally in startup land and to be sure to tap it. But I think the most common pathways we'll see are, we've got these problems, we've got these challenges. Hey, team, go figure out where there are solutions out there. And usually, hey, the search field is global, right? So what are the expectations? Now we're kind of getting into the, corporations kind of avoiding those common areas of failure. Well, we know why the corporates often are tapping this. It's ultimately the end game may be piloting with these startups, and pilot would generally mean that you're looking to be a customer of them if the pilot works out well.
Neal, sorry.
Yes.
I think that you're sharing your screen, but we keep seeing only the first slide.
Oh, thank you. That's interesting. I see. Sharing is paused. Bring your sharing window to the front. All right. Is that, are you seeing further slides? Yes. Okay. All right. Well, then
So
if you're
I would get out of, oh, now we can see it. Okay.
Got it. All right. Okay. Well,
a bit of time to notice. Sorry.
No problem. I appreciate that heads up. Otherwise, I just would have gone on for the next 5 minutes and you'd still be looking at a title slide. So expectations with the partnerships. Maybe let's go to the startups, because I think actually a big part of this conversation is understanding the startups mindset, because that will help, especially with expectations. I mean, why are startups looking to collaborate with corporates? I think we can recognize also there is there's a cross section of startups who aren't looking to collaborate with corporates. They're looking to directly disrupt them. But let's take the ones that are looking to work with startups, with corporates. Number 1 and 2 here probably shouldn't surprise you, is startups are looking for revenues. Either you directly as the corporate as a customer, or you represent some sort of market access, distribution for them, right? And that's especially when it's partnerships. So, if you put yourself in the shoes of a founder or CEO of a startup, cash is king so often. They're looking for market proof points, and they're looking to generate revenues. And not 4 years from now, but usually 4 months from now. And these, last 2 or 3 points here, reputation or reference, right? You as a corporate represent a blue chip, point of reference if you're working with them. That gives validity to the product, to their business, and hopefully some currency as they go try and sell their next customer. And then the last 2 here, funding. So that was just a reference, which may or may not be relevant for folks on this call, but startups more so than ever before are looking for corporates as strategic investors and earlier on in their life cycle than had historically been the case. And then of course, MVP, product definition, especially if you're going to be working with early stage startups, right? They're still trying to figure out, they think they see the need, the value proposition, the reason they probably left their last job to start a company against it. And you represent someone who can help them qualify that and be a proof point against it. So I'll continue on, what are the founders looking for? In working with you, there may be that unfair advantage. Obviously as the corporate, you've got massive resources, domain expertise, distribution, market knowledge. So looking to tap that in working with you. Sales channels was my earlier reference to distribution. Maybe as a part, maybe if you have an accelerator, right? And this is one of the value adds of accelerator programs is you've got facilities or data you're willing to share or IP that they need. That'll be a part of their overall offering. That industry and business expertise is what I was referring to, right? Is you're essentially a proof point for them. You may be helping them if you're working with early stage companies. You may be helping them guide their product roadmap very actively. And once again, they want to tap your network beyond, your mothership, your existing corporate, but other doors that you may be able to open for them, assuming that you're a happy and pleased customer or partner. So the challenge is that there is a lot of dissatisfaction. So probably in the last 10 years, as corporates and startups are working more and more and more together, this is perhaps not surprisingly, is there's a lot of excitement to do so, and there's a healthy amount of disappointment in the way those relationships play out. So why, right? And Bobby certainly hit upon this, and I'm sure it'd be no news to anyone here. It's the differences in time expectations. So, and corporates can take a long time to make a decision. if you're working with really early stage startups, the time to make that decision may be the life and death of a startup before the decision's actually made. I think one theme you're going to hear from me repeatedly, if you haven't already, which is expectations. And I think that's really what it's all about so often is, so as you sit in the corporate seat and you're interfacing and working with the startup, are your expectations aligned? So that can mean a lot of different things, but ultimately it boils down to what's the definition of success? So let's just take piloting, POCs, proof of concepts or pilots, setting those expectations up front. Like, here's the scope of the pilot. Here is what we're hoping to see on the back end, right? And then if that happens, hey, startup, here's what you can expect next. I'm going to introduce you to the business unit head. Hopefully they'll adopt it and roll you out, whatever the case may be. But it's the expectations of definition of success, timelines, metrics upon which to define that success, and then what are the next steps that would come after that waypoint. I think the cultural differences, those are pretty qualitative but very real. Just this, the styles of work. So you're trying to find that match earlier on. And then there can be some things like technological differences, and we've seen it before, right? Oh, wait a minute, you're an Azure shop. We probably should have asked that question earlier on. We can't work together because we're all in on X, Y, and Z. I think that, and so this is something that kind of comes to the forefront as you're honing on who to work with. One comment I want to make is kind of going back to that 90% failure rate. And, this is the VC model, tried and true. We look at it with the corporates is, they can't have a 90% failure rate in their engagements with startups. And often because that might be only 1 out of 10 pilots lead to a bigger, established relationship. But for a lot of the corporates, they're making a big bet in working with a startup. Less so about the dollars they're deploying, but more so of, so when we connect a startup to one of our members, one of our corporate members, if they like what they see, their answer may be, okay, great. Can you roll out to 1,200 stores next year? And we're going to train 25,000 staff on your solution. That's a much bigger bet, right? For the VCs, they know that they're going to write off most of their investments, and that's just dollars to go to zero. For the corporate or for the folks like yourself who are leading these decisions of which emerging companies to work with, you're putting a lot of political capital on the table, much less hard capital, and just time and energy. It's a bet that you're making. So a lot of our work with corporates, with startups, this would be a decision, which is what's the profile of the startups that you're working with? Are they very early stage in their life? Are they more established to kind of cross the chasm of death, which there's multiple chasms of death, certainly, in the startup journey. And so, when you're making a bet, this still, represents a startup, but it's a company with a meaningful balance sheet, with existing customer base that you can reference, a product that still may be early, but it's proven. And that's where, a lot of our work focuses, while also the corporates really want to make sure they have a finger on the pulse of what's coming, what is being developed by earlier stage companies. And they view it as they're going to meet those companies, develop a relationship, track them, and then maybe start working with them 12 months from now, 24 months from now. All right, this is my last slide. And this is actually from the lens of the entrepreneurs. So we've done a number of these webinars where the audience are the entrepreneurs. And the question is how to successfully work with corporates. So the other way around. And here's what we tell them, because I think it's equally as informative. The first is for those entrepreneurs, CEOs, make sure that they know the champion that they're working with. And do they have the ability to make decisions? Do they have the ability to control budget? Because sometimes you'll see they spend a lot of time with folks inside the corporate, only to recognize after many, many meetings that actually they need to be talking to this other person in order to get done, that initial engagement, that initial pilot, wherever the case may be. The second bullet point here is pilots. So we've probably said that word, 5 times now, and Bobby said it a few times. And but it's really, so often the entrepreneurs will find they get to a stage and the corporate says, yep, we'd love to do a pilot. Now that's going to be an unpaid pilot, which is really difficult for most startups, right? They're going to invest time, energy, potentially custom development cycles without the promise of repayment or a customer, relationship to come out the back end. So I think that maybe one thing you find as you're engaging with startups successfully is it goes a long way to actually have a budget to underwrite the pilots. Speed, we won't keep belaboring the point, but I'll go back to its expectation setting on the speed. And then that scale, that kind of went to my story about rolling out to hundreds of stores. I think this is really a fit match to be sure that for the entrepreneur, if it works out well with the corporate, can they meet the scale that the corporate will expect? And then the flip side is a corporate, if you're starting to assess and evaluate a startup, in order to ensure success, do you think if you do decide to go all in with them, that they can scale with the needs of your organization, whether that's the number of users, the scalability of the technology itself, or just the scale at which that startup can support the custom elements that you need, the handholding and rollout and whatever the product may be. And then the last piece that we counsel the founder CEOs is to recognize, and I think this with your corporate head on, certainly recognize you're going to have things that you want, need from that platform, that product, that solution, that you're going to be, injecting that feedback into the entrepreneur CEOs. But it's the job of the entrepreneur CEOs to recognize that may be what you need, but that's not a universal need of all the other corporates that they're trying to sell to. And so to recognize as you're engaging the startups, particularly if it's earlier stage, you may be pushing them in one direction because it's what your organization wants and needs, but you should also expect some pushback. And as they're assessing, is this relevant? Because they got to go sell whatever it is they're trying to sell to you many, many, many times over. And like any product management, trying to figure out what's the feature set that has universal or at least critical mass need versus, this kind of goes to the last comment, which is related. Often with the best of intentions, corporates can crush a startup. It's like the elephant trying to pick up the mouse, or choose your metaphor. And so this is our advice to entrepreneurs, engaging with you all who are in those corporate decision maker roles. But I think knowing their mindset really helps back to the opening here, which was how to be successful in your interactions, how to try and avoid the common failure points, the misalignment of expectations, and ultimately to choose the right startups and ensure that if you do end up working together, the outcome of that work is successful.
Thank you, Neal. So we already have a question, first of all, a compliment from Benny about this is a great summary. So thank you, Benny. And there's a question whether you have such best practices or advice for corporations that are setting up an innovation outpost or scouting practice.
Yeah, I'll keep it really brief, Ahi, because I know you've got some presentation and we're short on time. But yeah, I would say no matter where it is on the innovation outpost, scouting best practices. So ecosystems are driven by relationships. It's true the world over. And the one mistake we see is folks move someone from HQ to a far-flung ecosystem, parachute in and say, great, get plugged in very quickly, develop all the relationships and get the best flow, the best sourcing. It's basically expert scouting in those areas. And I think the biggest piece of advice we have is find the right partner on the ground in that ecosystem to make sure that you accelerate those efforts. And that you're actually seeing and tapping the best companies, right? So it's very hard. If I parachuted into Tokyo and had that mandate, it would take years and years and years where I would feel like, I've got relationships with the best entrepreneurs, the best VC backers of those entrepreneurs and companies. I'm seeing the best and the ideal flow, because ultimately the answer is always, it's not quantity of what you're seeing, it's the quality. And sometimes we'll work with these major corporates. They say, we see 100,000 startups a year. And our answer is, yes, exactly. That's a problem. Because in startup land, you probably only should care about 5% of those. The rest is noise. So if you're setting up an innovation outpost, find the right partner and the partner that's truly deeply plugged into that location of where the outpost is being set up.
Excellent. Any other questions for Neal? All right, so we're going to have hopefully a few minutes at the end for like a discussion where you can still raise questions if you think about anything. So what I'm going to share now, so I would like to contribute to today's discussion, is a topic about the risk-reward battle that we have in corporations. And I would like to talk about creating some sort of an adapted risk management practice, which sounds like a very big term, and I'll try to break it down. But the point that I'm trying to convey is that we talked about, and Neal said it, that corporations usually cannot afford to have 9 out of 10 of their startup relationships fail. And I think that also is very relevant when we talk about investing in organic innovation, right? It's not just the cooperation with startups, it's also if you're trying to nurture something that was grown organically. And the claim that I want to make today is that, that the main blocker for corporations to do that is risk aversion. It exists at an executive level, meaning the decision-making level, and it also permeates throughout every practice that the organization has. Because over many years that organizations are created and grow, their mainline business is really relying on the fact that they are working in a way that is risk averse. When you go to, you study your MBA or any management practices, there's this topic of risk management, and organizations try to avoid risk and mitigate it as much as possible. And they do it at various levels of the organization. And what I would like to propose is that if we could mitigate the risk in ways that do not prevent the organization from actually exploring innovative opportunities, then we could, you could say you could have your cake and eat it, right? We could still mitigate the risk overall so that it wouldn't be disruptive for the organization, but at the same time, we still are able to keep the potential impact of the innovative opportunities, be it organically grown or based on external technologies, such as from startups. How can we still keep this potential impact high? So at a venture level, if we look at how corporations work by default, their release process is usually sort of a waterfall model. Doesn't matter if you're a software company, a hardware company, if you have a manufacturing line. When you're creating something new, like a new product or a new service, it usually goes, stage by stage basis. You have these traditional risk mitigation activities that are performed in order to allow the organization to make educated decisions about that opportunity of creating a new product or a new service. Why? Because the risk that they're trying to avoid is that the innovative opportunity will fail, meaning it will not achieve product market fit at scale. So what they do is they try to mitigate the risk upfront. They do it still when there's a very high level of uncertainty. And the first time that the value proposition of the opportunity is actually tested in reality is when they build a pilot or when they create an alpha version or something else that they consider like a proof of concept, which are relatively expensive for them to try. So what that means, in other words, is that the cost of failing is high. Because if you look at the level of risk, it is maintained relatively high up until later stages of the process. And only when the pilot is released or the proof of concept is released can the risk be actually mitigated. So what happens is the organization realizes that the cost of failing is high, that the cost of the experiment is high. So as a result, what happens is that they can only afford a relatively small number of experiments, right? So if the only time where I can see my risk significantly mitigated is when I invest and release something to the world, be it a POC or a pilot or an alpha, it means that the cost of failing for me is expensive. Now, assuming that I have a limited budget for these quote unquote experiments, and the cost of a single experiment is high, it means that I can only afford a relatively small number of those experiments. And because we don't mitigate the risk up front, we only mitigate it later, my risk of failing is still very high. So what I'm doing is I'm making a small number of big bets. And when I make a small number of big bets, that is not really a good approach if we think about the venture capital models that are trying a lot of stuff and realize that they're going to have a high failure rate. That's not the approach that corporations can take by default because of the cost of the experiment and because of the fact that they don't want to take on too much risk. So just like we're taking a page out of the VC playbook, let's take a page out of the entrepreneurial playbook. So when you look at a methodology like Lean Startup, in Lean Startup, the focus is on risk mitigation while we're still maintaining a high impact potential. So if you think about Lean Startup, what it says is that you have, at every startup, you have a collection of assumptions that you're making at the beginning of your startup. And the right approach, according to Lean Startup, is to, first of all, mitigate the risk behind each of these assumptions, validate those assumptions, and then run an experiment, which is what is called an MVP, a minimum viable product, and only then invest in actually building something. Because if you know Lean Startup, if you're not familiar, I highly recommend that you get to know it. The concept of MVP, which I call here an experiment, is not about building something, but it's about validating, doing everything that you can except for building it, in order to validate that if you build it, you will be successful, to increase your certainty, in other words, to reduce the risk. And so at each stage of this entrepreneurial process, you are only going to the next step if you proved that in the previous step that the risk is not too high, right? If you think about a VC model, no startup is going to come to a VC with a slide deck and ask for round B funding. They can, but they'll be making fools out of themselves. You will only ask for seed at first. So here we're saying in a corporation, ask for some time. And then after you get some work time and you do the validation, you get to the next step, you ask for some budget for an experiment, not for a POC, not for a pilot, but for an experiment, which can be significantly cheaper. You know, for our clients, we make it around 10% of what the typical POC or pilot costs. And only if the experiment is successful, then you can ask for the next round, which is like building a pilot or a POC. What happens as a result is that you're gradually mitigating the risk up front. You are keeping the cost of the experiment low. And in that way, you're actually releasing, I claim, you're releasing the bottleneck, which will allow the organization to try a lot and actually fail more, but the cost of failing will be much lower, okay? Because the failing will happen sooner in the process at stages where the organization hasn't invested so much in this innovative opportunity. And as a result of that, instead of making a small number of big bets, you can actually manage a portfolio and do some strategizing. And I put it to you that the key here is the cost of the experiment and the amount of risk that you're taking for each of the elements in your pipeline. So now if we're talking about risk adversity and we handle it at the venture level, let's talk about risk at the portfolio level. So the risk that executives they might be aware of it, they might not be aware of it, but the risk that they're trying to avoid here by default is that the innovation portfolio won't generate an ROI that justifies the investment. So if I said it earlier about a single opportunity, now we're looking at the portfolio and the executive says, I don't know if I want to invest in this thing, this animal that I'm not familiar with, because I might invest in it, I will never see any ROI out of it because there's so much uncertainty built into it. And again, if the cost of the experiment is high and the budget is limited and the number of experiments is low, then the result is that the overall probability of success is indeed low. But if we think about wanting to get to a point where we have ventures in here that have a 20% probability of being successful in 3 years, sorry for the math, you have to trust me on this. If anybody wants to know the calculation, send me an email afterwards and I'll respond, but you have to trust me. If you have a collection of opportunities, each with a 20% probability of being successful in 3 years, and you want your overall portfolio to have an 80% probability of having at least one of them be successful, which will cover, your ROI and, get you to profitability, how many pilots are required? So in this particular arbitrary set of numbers, the answer is 7. So if you want to have 7 pilots that reach the end of this process, having filtered a lot of other options, that means that you need to try quite a lot. And that makes sense because if you think about the VC model, the VCs understand that in order to be successful, they have to allow 9 out of 10 opportunities to fail. So what we did by reducing the cost of the experiment, we gave the organization the tools that it needs to be able to have that high rate of failure and to get at the end of the process, after failing and filtering stuff out, to get to around 7, 10 pilots in their portfolio that they have a higher level of certainty that they want to invest in. So now, if we take a step back and we say, let's say that right now you would like to have that portfolio of pilots. Is now the time to start, or should you have started 3 years ago, right? So the thing is that by the time you realize that you need a portfolio of pilots because you're being disrupted, it's going to be too late to generate that portfolio. So the answer is, if you want to be innovative, you need to create this portfolio and start now. Because if you want to have this collection of opportunities to scale, in case you're being disrupted, or there's an opportunity in the marketplace that you want to capitalize on, then you should have started a few years backwards, because this is going to take time to build. It's going to take time to develop this portfolio, right? So you have to have this portfolio and you have to invest in it and have the time to build it, not wait for the last second. And my last point is the risk at the strategic level. So here the risk is that the scaled innovation portfolio won't generate an ROI that justifies the investment. And what happens is that the scaled ventures are cut back, they're limited, and they're constantly doubted. Because the ones that you're actually making decisions to scale, you're always doubting yourself. Because if you read about startups, the dynamic of creating something from 0 to 1, there's no rules here. It's like, it's half science, half art. And most corporations don't have the experience and the history of creating things from 0 to 1. Most people who work for corporations have inherited something that was created years ago, and they manage it. They take it, if it was at 100 and it went to 90, now they manage it back to 100. Or if it's at 100, they want to take it to 110. But not many of them know how to do it from 0 to 1. And so this is a tough thing to do. So our approach is that instead of looking at those opportunities that are being scaled through the lens of traditional risk management, first of all, you have to create a portfolio risk, innovation portfolio. The risk must be evaluated relatively. You shouldn't compare innovative ventures that are being scaled to traditional projects in terms of the risk levels, because this is still going to be relatively high risk. So you have to compare innovative opportunities, compare them to each other. Second is that the innovation portfolio risk must be evaluated separately from the mainline portfolio, as I just said. 3, the evaluation must be done using tools that are adapted to innovative ventures. You shouldn't be using the traditional tools of risk assessment. And 4, there needs to be diversification, right? So just as Bobby was talking about, over time, over the stage of the project, and over verticals, you need to think about your portfolio of opportunities as a corporation in similar lines that VCs think about their own. Don't put all your eggs in one basket, right? So of course, we cannot really review everything right now in detail in 15 minutes, but these are like the pointers that I wanted to give you, and just an idea of, what, some visual tools that you could use. For example, if you put on a grid your various projects, you show the relative investment, the spending velocity on one axis, the potential impact on another axis, and the relative risk levels. You can see, from a bird's eye view, you can have a glimpse of what your current portfolio looks like. And of course, you can do the same in order to see its distribution over verticals and so on. So I hope that was beneficial. We intend to give more webinars in the future where we hope to be able to dive more deeply into the details. If you're interested in more, you can pick up one of my books or connect to me on LinkedIn, reach out to me over email, or visit our website at spyre.group. I hope this was interesting to you. So we have a few more minutes, about 5 minutes. And I think that what we can do now is open the floor for discussion. If anyone in the audience has any questions, please feel free to ask. I have to say, guys, that one of the things that really was interesting to me was to see, as you were describing the world of venture capital, you were really touching on all the points that I encounter where I work with corporations, both for organic innovation and for open. This difficulty to allow themselves to fail a lot, the difficulty to really be able to experiment, right? Because for them, every time they work with a startup, they feel like they're committed. They put resources on it. They put executive time on it. So what are your thoughts about this concept of an experiment? You know, if we could somehow lower the cost of an experiment. So Neal, I'll ask you.
All right.
You're so polite. You're each waiting for the other one to start.
Sorry, I also wasn't sure if that was out to the wider group as well.
Ah, okay.
Yeah, no, I think it's the experiment ethos is definitely at the core of it, and then it's how to mitigate the various variables of the experiment, right? And with the experiment, you're kind of deciding what level of resources to commit against the experiment. And I would, going back to your comment just prior to that, we really look at it as whether it's internal and external, but definitely the external, right? You are using the same VC lens, right? There's hundreds of companies you could work with. You're ultimately trying to filter out, which one do you think is the right fit for you? Which one do you think has the right staying power? And also which one might you be able to mold towards the success you're looking for? But it really is that same, when you've got tons and tons and tons of options, what do you want to make a bet on? And what's the calculus upon which, and as Bobby hits, it's usually team and product and what data points are out there to give you a degree of confidence. What's their roadmap look like? Does that match with what you think your organization is going to need, not just today because of some problem statement that drove a call to open innovation and whatnot? So it's like all those factors, and much like VC, it's definitely art, not science, most of the time. And so that kind of leads back to the science reference, leads you to, it is experimentation, but you're always trying to, of course, set the stage for the highest probability of successful conversion, so to speak, of that experiment. And you are A/B testing, and you're also A/B testing your own organization, depending on where you are in the maturity of your innovation activities, right? I mean, I think the ones that are most mature, if they have a well-defined innovation team, they also have very well-defined pathways of how the work of the innovation team translate into commercial follow-through with other parts of the org.
Yeah, and I would just say that like when we look at McKinsey's 3 horizons, and we want to get to Horizon 3, which is truly disruptive technology that's almost feels like science fiction a little bit. That takes a little bit longer, usually 5 years or so to get to that point. Steve Blank came out with an article saying that, much like Ahi was talking about with Lean Startup, there's a way to kind of cut that down a little bit. So there are kind of ways to get to Horizon 3 innovation sooner, but it's a little bit of a longer bet. You kind of look at driving cars, kind of the way that with regulations, it's not something that, even though the technology may be ready, it's not something that they can actually bring to market just yet because of regulation. So kind of keeping in line with everything that Neal said, but also thinking about the way that we look at our roadmap for rolling out truly disruptive innovation can take some time, but certainly a lean startup approach can help with that.
That's maybe one point out. That's a really good point. One of the things we saw during COVID, which was really interesting, is a lot of our work with corporates turned from more forward-thinking activities to more like problem-solving right now. We need sanitation technologies yesterday. But we saw some groups who actually got pushed further out, right? Like, hey, your job now, innovation team, your job is really to be thinking 5 years out, because we're going through a big transformation. All the business units have to focus on the tyranny of the month to month or the quarter to quarter. So we saw it go both ways, and it was really interesting to see which groups said, we're going, like the oil and gas companies, we're going, we're moving away from oil, right? And hey, ventures team, now your mandate is more important and more out years oriented than ever before.
Very interesting. I hope that they will have the patience to wait for those teams to come up with the solutions, because it takes time to incubate. Guys, this was really fascinating. Unfortunately, we are out of time. So thank you so much for joining us today and sharing from your experience with the group. I would like to thank everybody who attended today. And we hope to see you soon on another global webinar. Thank you very much.
You.